It's no secret that right now, millions of investors around the world are panicking. Every possible indicator of a recession and a market crash is screaming at us, warning us of what is to come, and unfortunately for the bulls out there, the people who have a historic track record of predicting these kind of events, well, they're warning us as well. Today, we're talking about a man who has successfully predicted and made billions from market crashes in the past, who has now gone on record claiming that the US economy is heading into a financial crisis and an economic depression, and that very soon we are to witness a legendary stock market crash that exceeds 90%. We are, of course, talking about Harry Dent, who's been called a contrarian's contrarian. He's a Harvard-educated economist who leads HSD Publishing, a research organization. Their forecast is one of the company's newsletters. He has also authored several books which have gone on to become bestsellers, covering topics on finance and economics, so it's safe to say that he tends to know what he's talking about. Usually, he makes predictions based on demographics, market cycles, and major shifts in investor sentiment. Now, the reason we're talking about him today is because he has compared prolonged monetary stimulus by the Federal Reserve to supplying drugs to an addict. He's claimed that that is what we're seeing right now, and according to him, a doomsday is right around the corner. So today we're going to see what he has to say from the horse's mouth himself. But before I jump into today's video, I want to thank the Daily Upside for partnering with my channel. The Daily Upside is a free business and finance newsletter I actually use every morning to help get an edge on the latest business news. Check out the link in my bio to subscribe for free. Also, make sure to leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like private live streams, extra videos, and buy and sell alerts for my own personal portfolio.
It's as simple as this. We're in what I call the orgasmic phase of this bubble. It's just been building and building. People have to realize since 2007, and I called that one 20 years before it happened, late 2007, baby boomers peaked in their spending. We had a peak in the stock market in late 2007, and we went into the first deep recession since the early 80s and the early 30s, okay, the Great Depression. And that's when the Federal Reserve and central bank just went nuts. We have printed more money in the last year and a half or so than all of the printing before this, and even since 2008 and 9. I mean, just years and years of this. So they keep doing exponentially more. So they're just desperately keeping this bubble going. And when you get in this phase, there's no way to say, oh, it's going to happen this day or this month. I mean, I was able to predict the 2007 top because I could precisely determine within several months when the baby boom was going to peak and momentum was going to turn down. But this is just a bubble's going to go until it bursts. I'm now looking literally at chart patterns and things like that to see when this bubble looks like it's going to pop. And this looks like one of the times right here in December where it could top. If not that, it'll be early next year. After that, I'm going to be shocked if we do not see a downturn. So it's at the point where, to me, this is such an extreme bubble. If you're hanging in there to say, well, maybe it goes another 3 or 4 or 5 months, I'm like, get out. What my research does show 100% is that when a bubble like this bursts, you're going to see 40 to 50% crash in the first 2.5 months. And if you sit and wait for that, it'll happen before you're ready, and then you'll panic when that happens, and then it'll bounce, and then you'll look like a double idiot. So this is very tricky. And I think Baron Rothschild, the richest man of the 1800s in Europe, said, what is the secret to my success? I always got out a bit early. Okay, that's what I say. Be on the early side, and this is already way later than this thing should have gone. But the governments are exponentially selling more. Now, for the first time, with the economy only coming back in recent months, it was declining in the second, third quarter. Okay, after all that stimulus, it was declining. Well, it finally came back with this, recent stimulus. Okay, this has put them in a bind. They now have almost 7% inflation, and the next report's probably going to be higher in December. We're going to get that January 12th. And the economy has suddenly gotten strong. It was weak. Now, so they have to tighten. What I'm telling people, Danielle, when you have an economy that's now been stimulated for 12 years against fundamental demographics, against slowing even technology, all of my cycles are slowing at this point, and most of them for years, it will not take much to prick this bubble. That's what I'm saying. So just them saying we're going to have to taper and just starting, they're already cutting 30 billion a month and
Now, in the past, Dent has been early on more than one occasion, and while he does get his predictions right in the end, sometimes he is far too early. We don't have the luxury of being able to hold on to short positions for that period of time. Now, since 2020, Dent has made some serious claims about the US economy crashing, but it seems like his predictive powers aren't quite doing the trick, or they weren't until very recently. Alternatively, his analysis about the overall market doesn't seem to be all that wrong, as he expresses his worries about how the economy is actually scrambling and could probably be at a tipping point. In real life, it is difficult to accurately predict when a bubble will pop, and it's something that millions of people try to do, but most get it very wrong. Now, I don't think it's too harsh to say that Dent took it a tad too far when he claimed that his analysis about doomsday was 100% right on national television. It wasn't just a far-fetched analysis, it was irresponsible fear-mongering. But before I go any further, I want to thank The Daily Upside for partnering with me on this video. The Daily Upside is a free business and investing newsletter that over 250,000 people subscribe to, myself included. The Daily Upside was founded by a team of former investment bankers, scholars, and journalists with the intention to provide color and clarity to help investors sift through the noise of the financial news space. Instead of pushing clickbait financial headlines and biased coverage that traditional outlets have gotten used to, The Daily Upside provides perspective and actionable insights on the stories shaping the business world. Every weekday they deliver a morning brief, followed by more detailed stories on what is moving the markets. I started reading The Daily Upside 3 or 4 months ago, and it now has become the first thing I read when I wake up in the morning. It's about a 5-minute read that isn't afraid to give real, high-level, unbiased analysis with the occasional dose of wit to keep things interesting. Recently, I've been enjoying their weekend edition newsletter that goes a level deeper into niche industries. This past week, they dove into the water economy, which according to a recent Nasdaq study is worth north of $100 billion. As someone who looks to stay on top of news to help create videos like this, I can't recommend The Daily Upside enough. Click the link in my bio and join the 250,000 other people that read The Daily Upside every morning. It's free, and if you don't love it, you can always unsubscribe.
What typically happens, Danielle, and this has been every top in this boom since the early 80s, when the stocks markets go up for about a decade, they usually get pricked when the interest rates, inflation starts to rise late in the boom, and the bond rate, the bond rates go up. Now, the big thing right now, which is extremely unusual, we have 6.8% inflation and rising, and the 10-year Treasury bond is yielding 1.4%. That's like a negative yield of 6-7%. So I think the Treasury bond if it keeps edging up, that could be the trigger, but we're just way beyond this thing.
Harry, let me ask you, because that is the concern, right? That when the Fed would start tightening, what impact would that have on the stock market? But the Fed knows this, right? So won't they do everything in their power to avoid a stock market crashing? This is what they've been working so hard to avoid. They've been pumping. Why would they just put their guard down? Why would they have?
You got to remember, there's a lag to everything. Monetary policy lags about 8. Now it starts, but it lags about 18 months in its real effect. And so they've been forced to start to taper off. What I keep telling people, you got to understand addictions, you got to understand bubbles. They're both the same thing. Something blows up, it takes exponentially more to keep a bubble or an addiction going. And all it takes is just pulling back. You don't have to stop the stimulus, just less stimulus. And then no stimulus is all it takes at some point. So it's just a matter. And so now they're forced to get a little more tight. Well, if they're going to decide, if they pull back and immediately get easing quickly, it's going to look like they're panicking. So now that they're in a tightening mode slowly, it's going to take them a little while to respond and go the other way. And in that time, again, remember what I said at the beginning, 2 to 3 months. Every major bubble burst has happened within 3 years and has been from 42% to 50%. And my calculations on this one that's been so stretched is it's going to be 54% the first crash. If that first crash happens, if they just slip that long, people will lose confidence in this market. Imagine if the S&P dropped, 54% in 2 months. You think anybody believe, oh, well, they'll just print money again, it'll come back? You will not see the market come back if it crashes that much. I will almost guarantee you that.
Now, the stock market peaked in late 2007, and the United States entered its first really serious recession since the early 1980s. That's when the Federal Reserve and central banks decided that an urgent stimulus was needed to put the economy back on its feet. Since then, monetary stimulus has been exercised in regular intervals, but this has been peaking since the dot-com bubble, the 2008 crisis, and today. Now, I'm sure you've heard it before, but almost 50% of every dollar in circulation today was printed after the coronavirus pandemic begun. The quantum appears to be growing at an exponential rate. The central bank can conveniently buy trillions of dollars in government securities through asset purchase programs that we know as quantitative easing. The buying of securities provides much needed liquidity, but not without a cost. The prolonged effect of any stimulus is inflation, and despite what some modern monetary cultists will tell you, QE does cause inflation. The evidence of that phenomenon is right in front of us. Each and every time there's a financial crisis, the Fed prints more money. The problem is, every time this process is repeated, it has to get bigger. More money needs to be printed, and more assets have to be bought. This means that during the next financial crisis, to compensate for the effects of loose monetary policy in previous years, everything is going to get worse. That might just be the point at which the US loses its role as the world's reserve currency, and that is a major risk, and it could be one that leads to the massive disaster that Dent is predicting. Taking trends from the past and drawing them forward, and the Fed is probably going to need to print 10 times as much money to get us out of the next crisis, and it should be clear to everyone watching that this is not sustainable.
A bubble's going to go until it bursts. I'm now looking literally at chart patterns and things like that to see when this bubble looks like it's going to pop. And this looks like one of the times right here in December where it could top. If not that, it'll be early next year. After that, I'm going to be shocked if we do not see a downturn. So it's at the point where, to me, this is such an extreme bubble. If you're hanging in there to say, well, maybe it goes another 3 or 4 or 5 months, I'm like, get out. What my research does show 100% is that when a bubble like this bursts, you're going to see 40 to 50% crash in the first 2.5 months. And if you sit and wait for that, it'll happen before you're ready, and then you'll panic when that happens, and then it'll bounce, and then you'll look like a double idiot. So this is very tricky. And I think Baron Rothschild, the richest man of the 1800s in Europe, said, "What is the secret to my success? I always got out a bit early." Okay, that's what I say. Be on the early side.
Now, according to Dent, all assets, including gold, are also at risk, while treasury bonds should profit the most from asset price deflation. Gold and treasuries have different hedging properties. According to him, gold is the ultimate inflation hedge. The ultimate deflation hedge, though, is treasury bonds, which are widely regarded as the highest quality bonds in the world. He also predicts that a financial asset catastrophe would not be sparked by an economic slowdown, rather a market crash would induce a recession. It's the other way round, and that may be what we're watching right now. Interestingly, he also shares a peek into his philosophy on cryptos and Bitcoin. His belief is that when stock markets plummet, the crypto asset class is going to crash even harder. Dent states that at this point in time, cryptos are in a baby bubble. He even goes on to draw parallels between crypto and tech stocks during the tech bubble and sees a major crash in crypto, with Bitcoin reaching record lows, something that more and more people are starting to predict. The correlation between Bitcoin, other cryptocurrencies, and the tech stocks that make up the NASDAQ is undeniable.
You know what I'm parroting the cryptos on today? On the .coms. Amazon came at the end of that bubble. That wasn't the bubble, the Amazon, the .com bubble. It was it was a broad internet and tech bubble. The .coms came in the last few years and started to roar, just like the cryptos here, at the end of this bubble, and then burst. Amazon went down 95%, and the internet index went down 96%. I call it the baby bubble. New sectors emerge. The smart people say, oh, this is the next big thing. And I am on that train. I am crypto. I call it PCs, internet, crypto. The 3 big stages of technology. This is the next big thing, but I've studied these big things. They have a baby bubble, the most extreme crash. Then they have the daddy bubble, okay, that lasts much longer. So I'm saying crypto will crash more than the stock market, 95, 96%, something like that. Stock market, 87%. And guess what will be the best buy out of this? I'm not going to buy AT&T or IBM. I'm going to buy freaking Bitcoin and Ethereum and Cardano, whoever, Solana, whoever survives this thing. You know, there's 9,000 coins. Some people say there's 14,000. This is crazy.
So
this is typical of a baby bubble.
You would step in and buy.
Oh, I'd say it'd be the buy of a lifetime, not just to buy this next crash, which will be the largest in our lifetime, if I'm right, but to particularly buy the crypto sector, because it is the leading edge, better than biotech, better than other sectors, and that's all part of it too. And nanotech, buy the crypto sector will be the best buy.
Because it would come back roaring in how long should a crash happen on the cryptos?
Yes. Okay. So they'll probably be the first to bottom, maybe, 2021. 22, it's the late 22 instead of 23 for most stock. And I say the next boom will come from 2024 to 2036, 37. And that's right about parallel to a 20-year lag. The cryptos may go a little longer than that, but I call the crypto movement a 20-year lag on the internet. And the internet did the same thing. Remember, baby bubble crashed 96%. And then internet went up 600 times 600 times in 12 years. That's what I'm talking about. So that's bullish. You couldn't get more bullish than that.
Now, the important thing to take away here is that when people start selling their financial assets, money vanishes. When debt is paid off or written off, the money supply decreases. People become increasingly anxious, and that sharp drop in consumer confidence, that is what causes a recession to follow. The financial asset crisis actually sets off the recession, as it did in 2000 with the dot-com bubble. So does Harry Dent see something similar this time around, or are things going to be different?
Yeah. I see 2022 from the highest point in the stock market early on, if not already peaking here in late December. From the highest point to the lowest point will be the worst single year for the stock market in all of history. Now the crash will not be quite as bad as 89, but that next year, since we've held this back so long and bubbled it up and pushed it so far, when it finally breaks, I think 2022 will be the worst single year. So I just say, give me like 3 to 6 months, okay? Just give up a little gains. Now the market's so stretched and they're going to have to taper. The market's not going to do great when they're tapering. Just be out, be safe for several months. And if it doesn't start by then, okay, you can jump back in. But I'm just telling you, if you miss this, it will happen so fast, you will not be able to react enough, and you'll react just at the wrong point when it's bottoming, and then it'll get back past the gains, and then it'll go down for a couple of years. That's the scenario. Crash 50% or so, retrace about 40 to 50% of that, and then go dribble down for a couple of years. That was the same thing happened in the Great Depression and the 2000 to 2002 crash led by technology like this.
Now, Dent's forecasting skills are honestly on point. He has just been a little bit early on this call, but right now, in January of 2022, few people will still be criticizing him for that today. We've literally doubled the indexes in 2 years just as a stimulus to stave off the recession that would have occurred in the first place had all this stimulus never been pumped into the system. Investors are slowly waking up to the fact that the Federal Reserve cannot raise interest rates, contrary to what has been officially announced by Powell and co. The US dollar is being strangled to death every time there's easing. There's way too much money in the economy, and inflation is raging. The truth is that, unfortunately, you just can't bet against the Fed. Structurally, the system is broken, and if not for government intervention and stimulus, this would have ended a long time ago. Now, I never thought after 2008 that we could have kicked the can as far down the road as we already have. There's just no way of knowing how much road is left and to which extreme governments will go to mitigate this situation. Savings rates are negative with inflation, which drives average people and boomers, retired people, into risky investments in order to chase returns. These people have no business being in an overinflated equity bubble, and they will get crushed during the next correction with no capacity to rebuild. If you do the right thing and preemptively move to crash, and a crash doesn't come because governments step in and stimulate the markets again, then inflation eats away at your capital. If you stay in the market, you risk losing 20 to 50% in a black swan collapse. We are living in scary and uncertain times, all thanks to, as Dent articulates, an artificial bubble created by the US government. Boom and bust cycles are inevitable, and surely uncertainty lies ahead of us, especially when you have stormy foreign relations with China affecting trade and finance. To top that off, we have worries of a contracting labour market. Billionaires dumping tech stocks and overheating of the housing market are clear catalysts to this theory. In my daily market updates, we've already covered how the Nasdaq and the S&P 500 indices have started to show weakness amid the turbulence in the Federal Reserve. The economy is long overdue for some higher interest rates, and it will certainly hurt asset prices and portfolios, but it's time we embrace this necessary evil and stop believing that memes and tweets are going to save the stock market and the economy. A country is built on the hope and expectations of its people. Livelihoods depend on decisions like this. Now, coming back to Harry Dent's previous prediction, which was evidently wrong about the market crashing in April of 2021, we can only wait and watch if his latest forecast on the market collapsing in the first half of 2022 follows through. So far, it seems that he just might be right this time, and with the Fed making moves to taper, we can expect a correction, but a full-blown crash? Only time will tell. Finally, I just want to give the Daily Upside one more thank you for partnering with me on this video. If you haven't subscribed already, then click the link in the bio to receive their weekday and weekend edition absolutely free. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio, and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support, thanks for watching, stay stoic, until next time.